Orthodox economists blame this inflation on guns and butter spending during the Vietnam War, the decision to pay for that war with deficit spending rather than by cutting expenses or raising taxes. But that explanation doesn't really hold up particularly well, as the ratio of government debt to GDP actually declined from 43% in 1965 to a very low 33% in 1972. And note that the Vietnam War had less economic impact than America's major wars. Its expense to GDP peaked at roughly 10%, while in World War II it was nearly 40%, and the Vietnam War was isolated to a small geography that did not dent the world's productive capacity. It's also hard to make the case that the 1960s inflation was brought by high money supply growth, since the ratio of money supply to GDP did not grow. GDP grew crisply. After all, it was the go-go 60s, and M2 grew at essentially the same pace. But there are a number of instances of high money supply growth occurring at the same rate as GDP growth that did not bring high inflation. Instead, the most notable factor in the 1960s was the determination of the United States to defend the dying Bretton Woods-era gold standard of $35 an ounce, even as the market price of gold had increased to a level above that, allowing foreign entities to redeem their dollars for gold at $35 an ounce and then sell it at a higher price in foreign markets. There were efforts to intervene, especially by raising interest rates to make financial assets such as CDs and bonds a more attractive relative to gold, but that arbitrage drained U.S. gold reserves, and U.S. gold supplies plunged from 20,000 metric tons to less than 10,000 metric tons at the end of the decade.